This is a $100 bill. In your wallet right now, you probably have a few of them. Maybe in a drawer somewhere, tucked away for emergencies. You trust this piece of paper because the United States government stands behind it. Because for 80 years, the dollar has been the foundation of global trade, the reserve currency of the world, the one thing every nation on earth agrees has value. But here's what's strange. This same piece of paper, this $100 bill, has lost 23% of its purchasing power in the last 4 years alone. And the people losing faith in it fastest aren't conspiracy theorists or gold bugs or fringe economists. They're the central bankers of America's closest allies. The institutions that have spent decades accumulating trillions in dollar-denominated assets. Last month, Japan's Ministry of Finance filed a routine treasury report. 43 pages of tables and footnotes that almost no one reads. Buried on page 27, a single line item that changes everything. Japanese holdings of U.S. Treasury securities declined by $63.8 billion in November 2025. Added to October's decline of $71.2 billion. Added to September's decline of $58.4 billion. That's $193.4 billion in 90 days. Nearly $200 billion. The largest 3-month liquidation of U.S. Treasuries by any foreign holder in history. Japan didn't announce this. There was no press conference. No statement from the Bank of Japan. No warning to the Federal Reserve. They simply sold. Quietly. Methodically. While American markets were focused on inflation data and earnings reports, America's largest foreign creditor was heading for the exit. This is not about Japan rebalancing a portfolio. This is about the second largest economy in the free world losing faith in the financial foundation of the first. Here's what they're not telling you. Japan has been America's most reliable creditor for 40 years. When the U.S. needed to fund wars, Japan bought treasuries. When the U.S. needed to finance bailouts, Japan bought treasuries. When the U.S. needed to paper over trillion-dollar deficits, Japan bought treasuries. At the peak in 2021, Japan held $1.33 trillion in U.S. government debt. More than any other nation. More than China. More than all of Europe combined. This wasn't charity. It was strategy. Japan runs massive trade surpluses with the United States. Those surpluses generate dollars. Those dollars need to go somewhere. For decades, the safest, most liquid place to park excess dollars was U.S. Treasuries. America got cheap financing. Japan got a secure savings vehicle. The relationship was symbiotic, stable, foundational to the entire post-war financial architecture. What changed was interest rates. Not American interest rates, Japanese interest rates. On January 24, 2024, the Bank of Japan ended negative interest rate policy for the first time in 8 years. Rates went from minus 0.1% to zero. A year later, in January 2025, they raised again to 0.5%, then 0.75% in July, then 1.0% in October. For the first time since 1995, Japanese savers can earn meaningful yield in their own currency. For the first time in a generation, there's a reason to bring money home, and they are bringing it home. The yen carry trade, the multi-trillion-dollar arbitrage that borrowed cheap yen to invest in higher-yielding foreign assets, is unwinding. Japanese insurance companies that spent 20 years buying U.S. corporate bonds are repatriating capital. Japanese pension funds that held 30% of assets in dollar-denominated securities are rebalancing toward domestic bonds. The official story is that this is healthy normalization. The financial press describes it as rotation, gradual, orderly, nothing to worry about. But the data shows something very different. You don't sell $200 billion in 3 months if you're rotating gradually. You sell $200 billion in 3 months if you're trying to get out before something breaks. This is where the lie becomes unsustainable. To understand why Japan's selling matters, you need to understand how the U.S. Treasury market actually functions. It's not like a stock exchange where millions of independent buyers and sellers determine prices through continuous trading. It's an oligopoly. A small number of massive institutions set the market. There are 25 primary dealers authorized to trade directly with the Federal Reserve. These banks, J.P. Morgan, Goldman Sachs, Citigroup, and their peers, are required to participate in every Treasury auction. They're the market makers, the buyers of last resort, the institutions that absorb supply when foreign central banks step back. For 40 years, this system worked because foreign central banks, Japan, China, Saudi Arabia, the Gulf states, were net buyers. Every month, more foreign capital flowed into treasuries than flowed out. The primary dealers could warehouse inventory, knowing that foreign demand would absorb it. Auctions were oversubscribed. Yields stayed low. The debt machine hummed along. Now the flow has reversed. Foreign holdings of U.S. Treasuries peaked at $7.7 trillion in September 2021. Today they stand at $6.9 trillion. That's $800 billion in net sales over 3 years, and the pace is accelerating. Japan's $200 billion in 3 months is not an outlier. It's a trend going vertical. The primary dealers are not equipped for this. Their balance sheets are constrained by post-2008 regulations. Their risk appetite is limited by recent losses. When Japan sells $63 billion in a single month, someone has to buy it. If foreign central banks aren't buying, if domestic institutions are already overweight treasuries, then the primary dealers have to absorb the supply. And when they absorb supply, they demand higher yields to compensate for the risk. This is why the 10-year Treasury yield spiked from 4.2% to 4.9% between September and December 2025. Not because of inflation data, not because of Fed policy, because the largest foreign buyer became a seller, and the market structure couldn't absorb the shift. When institutions do what Japan did in Q4 2025, they're not managing portfolios, they're signaling distrust. The timing of Japan's sales reveals the strategy: September, October, November. 3 months when the Federal Reserve was still talking about rate cuts. 3 months when the official narrative was that inflation was defeated and monetary policy would ease. 3 months when, if you believed the Fed, holding treasuries would generate capital gains as yields fell. Japan didn't believe the Fed. Their sales accelerated precisely when conventional wisdom said treasury prices would rise. They sold into strength. They used the optimism about rate cuts as a liquidity window to exit positions that took decades to build. At 2:30 a.m. Tokyo time, on November 14th, the Bank of Japan intervened in currency markets for the first time since October 2022. They spent $22 billion defending the yen, which had weakened to 156 to the dollar. Currency intervention requires selling dollar assets. The same treasuries they'd been accumulating for 40 years became ammunition to defend their own currency. This creates a doom loop. Japan sells treasuries to defend the yen. Selling treasuries pushes yields higher. Higher yields strengthen the dollar against the yen. Yen weakness forces more intervention. More intervention requires selling more treasuries. The last time this cycle activated was 2022. Japan spent $60 billion in intervention over 2 months before pausing. This time, they've already spent $40 billion in intervention, while simultaneously liquidating $200 billion in underlying holdings. They're not just defending the currency, they're restructuring their entire foreign reserve position. Less than 6 weeks remain before Japan's fiscal year ends on March 31st. Institutional investors in Japan finalize annual allocations before this date. Insurance companies, pension funds, and banks must report holdings as of March 31st. If the selling pressure we've seen in Q4 continues through Q1, another $150 billion in treasury liquidation is likely. Combined with reduced buying from China and persistent sales by European institutions, total foreign demand for U.S. treasuries could turn negative for the first time since the 2008 financial crisis. While one side sells, the other side must borrow. This is the asymmetry that makes Japan's exit so dangerous for the United States. Japan stepping back as a buyer would be manageable if the U.S. were running balanced budgets. It's not. The federal deficit for fiscal 2025 is projected at $1.9 trillion. The government must borrow $1.9 trillion from someone just to pay existing obligations. If the largest foreign lender is now a net seller, that $1.9 trillion must come from somewhere else. The options are limited. Domestic buyers, American banks, pension funds, insurance companies, are already the largest holders of treasuries. They cannot absorb unlimited additional supply without demanding higher yields. The Federal Reserve could restart quantitative easing, but that risks reigniting inflation precisely when they've declared victory over it. Higher yields are the release valve, the price the market demands when supply exceeds demand. But higher yields create their own cascade. Every 1% increase in treasury yields adds approximately $300 billion in annual interest costs on the federal debt. The U.S. already spends more on debt service than on national defense. At 5% yields, interest payments approach $1.2 trillion annually. At 6%, they exceed $1.4 trillion. The deficit grows because yields rose. Yields rose because the deficit grew. Another doom loop. Another spiral with no exit. This is what the end of foreign subsidy looks like. For 40 years, foreign central banks, led by Japan, provided the United States with the cheapest financing any empire has ever enjoyed. They bought our debt at yields that barely exceeded inflation. They recycled trade surpluses into treasury purchases that kept American borrowing costs artificially low. They funded wars and tax cuts and stimulus programs that would have been impossible if America had to borrow at market rates. That subsidy is ending. Not because foreign nations decided to punish America, but because their own economic circumstances changed. Japan needs yield for its own retirees. China is diversifying away from dollar risk. European institutions are managing their own crises. The flows that defined global finance for 2 generations are reversing. This is what a system looks like when the creditors lose patience. Every response available to the United States now carries costs that previous generations never faced. Cut spending, and you trigger recession in an economy addicted to deficit stimulus. Raise taxes, and you suppress the growth needed to service existing debt. Print money, and you cheapen the currency that allies are already fleeing. Do nothing, and yields rise until something breaks. The $200 billion Japan sold in 3 months is not the crisis. It's the signal that the crisis is approaching. The institutions that financed American deficits for 40 years are repositioning for a world where that financing is no longer automatic, where treasury auctions might fail, where the buyer of last resort becomes the seller of first opportunity. Some will watch the treasury market and see stability, auctions still clear. Yields are elevated but not catastrophic. The dollar remains the reserve currency. The system functions. These are the same voices that said the housing market was fine in 2007, that European sovereign debt was risk-free in 2010, that inflation was transitory in 2021. The voices are always calm until the morning they're not. Others will read Japan's Ministry of Finance reports, will track the monthly tick data showing foreign holdings. We'll notice that the largest creditor America has ever had is liquidating positions at a pace never seen in peacetime. We'll understand that a nation doesn't sell $200 billion in bonds because it's rotating portfolios. It sells $200 billion in bonds because it no longer trusts what those bonds represent. The informed are not panicking. Panic is for those caught by surprise. The informed have watched Japanese yields rise for 2 years, have tracked the yen carry trade unwinding, have seen the intervention data, the reserve composition shifts, the quarterly reports that tell a story the financial press won't print. What the informed understand is simple. The arrangement that allowed America to borrow beyond its means was never permanent. It was a product of specific historical circumstances: the Cold War, the petrodollar, the Japanese export miracle, the Chinese manufacturing revolution, that created a world where foreign nations needed to hold dollars. Those circumstances are changing. The world that needed American debt is becoming a world that has alternatives. This is not financial advice. This is not a prediction of collapse or a recommendation to flee the dollar. This is simply an observation that relationships built over decades can change in quarters. That the largest foreign holder of American debt just sold more treasuries in 3 months than most nations hold in total. That this happened quietly, without announcement, while markets focused elsewhere. The $200 billion is gone. The question now is what comes next. Whether Japan's sales were the peak of repositioning or the beginning of something larger. Whether the buyers who absorbed those bonds can absorb the next wave. Whether a nation that has depended on foreign creditors for 40 years can function when those creditors become sellers. Japan's message was delivered not in words but in transactions. $200 billion of transactions that say, more clearly than any press conference could, that the relationship between America and its largest creditor has fundamentally changed. And once changed, some relationships don't change back.